Yeah.
Okay.
All right. Ready? 1, 2, 3, action. Welcome to another episode of the TBI show, guys. And today on our show, we have a special guest all the way from Chicago, Sarry Ibrahim, who is a insurance broker, owns his own company out that way. And thank you for being with us today, Sarry.
Hey guys, thank you so much for having me on. I appreciate it.
And you're, like always, your host for the night. This is Scott and Singh.
This is Navroop Judge.
And today we will be chit-chatting with Sarry about a lot of different things, insurance related, business related, some cool insurance products that our people can learn about. I know there's lots of things that you can learn about in insurance in that field. So welcome to the show, Sarry.
Well, thank you.
Wait, I would like to interrupt real quick.
Mm-hmm.
Our third co-host, Wei Ming Peng,
Yeah,
is hanging out with the mayor of San Francisco, which is why he can't be here tonight. So
That's pretty cool.
why he's absent. So we'll give him a pass. You know, you want to hang out with the London breed. Yeah.
legitimate excuse. And we've just been toiling with this setup of ours here, doing these remote podcasts. It's definitely a challenge. We're technically challenged right now, but hey, it sounds pretty good. We're recording this on Zoom, so thank you, Sarry. Thank you. Sorry for the wait.
No problem.
Yeah, so
No
welcome
problem.
aboard. Tell us more about yourself, Sarry.
Yeah, definitely. So I'm from Chicago, Illinois. I was born and raised here. I live in the city, and I'm the founder of a company called Financial Asset Protection. Pretty much, it's a financial services firm that we specialize in one type of strategy called the bank on yourself strategy, also known as the infinite banking concept. And we pretty much use this concept to help real estate investors and real estate brokers. That's our primary niche, and help them pretty much grow wealth while also still being able to access the funds to invest in real estate in other places. So they're not necessarily tying up cash in one solution, but it's more of an integrated approach that they could do more than one thing. That's pretty much what we do and what we help and how we help clients.
Awesome. Cool. So basically you were saying that this is a product which goes with whole life insurance.
Mm-hmm.
Okay. Could you break down what whole life insurance is, how that compares to term? I think a lot of listeners may not be familiar with the differences and nuances of those two.
Yeah, definitely. So this strategy does use whole life insurance, and pretty much overall, there's three types of life insurance. There's term, whole life, and universal. Term is like a set period of time. It's either 10 years, 20 years, or 30 years usually. And it has a start date and it has an end date, and it's life insurance only. So for example, somebody's 30 years old, they'll get a 20-year, policy, pay for it every month. And then at the age of 50, it pretty much ends, cancels, or they can renew it for a higher rate. But it does have an end date. And there's also no equity. There's no cash value in the policy. It's just life insurance only for that period of time. Whole life, it has a start date, typically no end date until you pass away. So it's for your whole life, like the title of it. And then the other difference is there's equity in it. It's like buying a home. It's a long-term strategy, and there's equity in it, or a cash value that you could leverage and that grows over the years. And the universal is pretty much a combination of term and whole life. It has a start date. It renews every year. There's some fluctuations in it. You could turn off premiums, turn on premiums, but I won't get too far into universal life just because it doesn't have the same guarantees as whole life insurance, which we need when we're applying these strategies for investing and for other saving purposes. It has to be whole life insurance. So pretty much whole life insurance, it has the cash value, and that's what we're emphasizing on. We're not really emphasizing on the life insurance, even though that's an important piece of the puzzle. It's more about the cash value build up and how it's structured.
Gotcha.
So can we dig in a little bit more deeper? Can you tell us in more of layman terms for our listeners, because what that all that really means, practically speaking? If we have a young listener listening, or someone that's in there, like, who is this for? Can you elaborate a little bit more about that?
Yeah, for sure. So this could be pretty much applied to, it's typically, I think it's kind of hard to put a demographic behind this, like who would be best for, but pretty much somebody who has like a cushion of like $500 to $1,000 a month. They want to save into a solution, some sort of solution. They may have like a 401k at work, or they might have a 403b at work, or they might have some sort of retirement solution that they're thinking about doing. This could actually be used in place of that, or in connection with it. So for example, somebody is 30 years old, they get a policy, they're putting in $500 per month, they're funding it. Now, as they are paying into the policy, two things are happening. One is that they're buying life insurance, and the second is that they're building up cash value. So a portion of the dollars that they're allocating to the policy, that are going into the policy, are going to build up the cash value. And as it's building up, the cash value is going to earn interest and dividends from an insurance company that it's a part of. So it's going to grow over time. And then you, as the saver, now have access to these funds via loans. So you could borrow against them to use for anything you want, up to 90% of the cash value. So obviously, the more you put in, the more premiums you put in, the higher your cash value will be. And then the higher the cash value will be, the higher the dividends and interest will be, and so on. So
So
pretty much,
sorry to cut you off. So if you have a premium for this life insurance, does all of the proceeds into this premium get allocated to like is it like an investment instrument that
Does all of it go to the cash value?
yeah, there's an allocation of something called base life insurance, and then something called the paid up additions rider. This is it's a whole life insurance policy. It's not an investment. So it's a portion of every dollar you go. Usually it's 50. Usually it's a 50-50 split. So every dollar you're putting into it, half of it is going towards the base life insurance, and the other half is going towards the paid up additions rider. The paid up additions rider is a piece that you add onto the policy that helps increase or turbocharge the cash value over time. So pretty much if somebody puts in $10,000 their first year into a policy, year one, they could see cash value of like 5,000. And then year two, they're gonna put another 10,000 in, and they can see a slight increase. By about year 3.5 to year 4, they'll have a break-even point, meaning that the cash value now meets the premium dollars they put into it. And then after that, it pretty much starts to outpace what they're paying into it. Now they might set up the policy to be paid in for 20 years. So it's a whole life policy, but we're only going to pay for it for 20 years. And then after that, the policy now takes off and it keeps paying for itself and it keeps earning interest and dividends, even though you've stopped paying into it. So in other words, the cash value that is proportional to the premiums. And I don't know if that answered you guys' question.
The whole life policy, right? Because term, you said, you can have it for 20 years. And after that, you can kind of decide what you want because it expires. Mm-hmm. Will the whole life articulate what your premiums are for the rest of your life? Or will there be a time period where it kind of recalculates what your premium is going to be?
So the cost of insurance is going to be fixed for a 20-year period, but then there's the base insurance and the paid up additions rider. So for example, if somebody says, I want to do $10,000 a year, but 5,000 of that, 50% going towards the base for 20 years, then they're on the hook for a 20-year period of putting in $5,000 a year. Now the paid up additions rider is flexible, meaning it has a minimum and a maximum every year. Typically, for example, in this example, the minimum would be like $100 a year, and then the maximum would be like an extra $10,000 a year. So every year they could put in $5,000 towards the policy, plus add in a minimum of $100 to a maximum of like $10,000 on top of that towards the paid up additions rider for a 20-year time period. So there's flexibility in the sense of adding more money into it and being able to borrow.
So these funds are being invested, and the borrower can borrow from those funds. And we'll get into like what are the interest rates and stuff that the borrower can borrow from. But first I wanted to ask is, who chooses where these funds are being invested?
Great question. Yeah.
Yeah, that's a really good question. It's the insurance company. So for example, we work with 3 insurance companies. One of them, let's just put a name out there, Lafayette Insurance Company. So let's say, for example, a client wants to use Lafayette Insurance Company. They have a whole life policy. Lafayette is going to take those dollars on the back end, and they have some banking functions where they're taking in premium dollars and then investing them in different places to earn a profit every year. The difference is between banks and insurance companies is that insurance companies are more regulated or highly regulated as opposed to banks. So they can only invest in certain areas, like the bond market. About 60 to 80% of their dollars are in the bond market. 20 to 40% are in private loans that they charge interest on. So typically the insurance company chooses where those investments are. You, the client, it's more of like a fixed product. You're going to get X, Y, you're going to get, this insurance product with this amount of cash value, this amount of dividend projection, and then interest. Now where the twist comes in with real estate is you get to do whatever it is you want to do with that money. So let's say you're building up into this whole life policy. You have, $20,000 in cash, you're building up cash value. Now you can start leveraging this cash value in the policy that you're building up to use for more higher risk investments and of course higher returns. You're only earning typically between 5 and 6% compound interest in the policy, but that's good because it doesn't stop there. We're going to borrow from that policy and then use in different areas so that we could typically earn 8 to 12% in other areas like real estate investing or different areas. So now your dollars are doing 2 things for you. One, they're building up your cash reserves. And then the second is that you're building up your investment in whatever it is that you want to do.
why would somebody invest through here instead of just opening up their own stock brokerage account or investing dollars that they have in a bank account is one question that I have.
Mhm.
And like there must be some benefit, whether it be that, oh, it's going towards your premiums, or whether it's, some sort of synergy or tax benefit, something like that, right? Or guaranteed. What would be one reason, like one benefit of, putting the money in and then borrowing from there rather than just directly investing?
Yeah, good question. So when you, for example, take the cash that you have and then you trade it for an investment, then you lose the opportunity cost you could have earned had that cash been invested somewhere. Yes, you could still earn interest now on those dollars that you traded for the investment, but there's also probably a volatile area now that you've invested, especially in brokerage accounts or stock accounts. So with using the whole life policy in between you and the investment, you kind of create a hedge against the uncertainty. So now you could borrow from the policy, use for the investments, and if the investment fails, you still have, or the investment dips in value, you still have the whole life policy increasing in value over time. So no matter what, there's like a positive slope of earning interest and dividends over the years that won't be interrupted. And I think that's key for a lot of people, is that the key, in my opinion, the key to success and financial being rich or financially successful is that having uninterrupted growth. It's that having that 5 to 6% compound interest every year, and the ability to leverage those funds for other investments at the same time.
Ability for it to be liquid. And my question was going to be on the liquidity portion of it. Yeah, when you initially start this investment, you're in year 2, 3, 4. What year? I mean, what year can you first pull out of it as a liquid form? And what is what do you see in the market, and what's recommended? And when will there be a point where you're like, okay, that's when it's really growing, and that's when you can really your assets are going to be at a certain place where now it makes sense to pull out because you have enough money in there. I don't know if that's a lot of two questions in one.
And what would be the terms of this loan when you pull it out?
Okay, yeah, for sure. Let's start with when can you take money out. So you could take money out starting in month 1, depending on how much the cash value is. So for example, if you're putting in, $1,000 a month in the first year and the first month, that's when the cash value is going to be the smallest in proportion to the cash value. So if you put in 1,000 in month 1, your cash value might be $500, and then you could borrow up to 90% of $500. You could borrow that for anything you want, for whatever reason you want, and then you could pay it back on your own terms and whenever you want. So for example, you can split that payment into annual payments, monthly payments over 5 years, 10 years, whenever you want. But we do recommend that you pay back that loan within reasonable time. Of course, reasonable time is kind of hard to judge, but you want to kind of make it a habit to borrow and then pay back on your own terms. So this way you can go back and borrow again.
And you could set your own terms.
Yes.
That's pretty cool. So you could charge yourself like interest?
So you could control the payback period, how and when you pay it back.
But then it's like you're making your account grow, right? So if you charge yourself interest, you're putting more money into it, it's growing for yourself, right? Your cash value is increasing there, no?
Yeah, exactly.
Can it work like that, or am I not understanding it correctly?
It does work that way, but that's more of an advanced strategy. That's more of, for example, you are an individual, you're personally, and then you have an LLC or corporation. You're gonna loan money out, borrow it from the insurance company at 5%, sell it to the entity that you own, the separate LLC or S corp or C corp, and charge yourself 8%. And then you can kind of there's some tax deductions there, tax benefits, but of course you want to sit with a CPA or a CFP first before you do these kind of things, and then you could pay the loan back. And then if there's excess now profits from that, you can roll that into the whole life policy, adding in more cash value. So now it's like a cycle of compound interest that you can keep recycling over and over again.
So let's say you have $1,000 cash value and it's being invested in the insurance fund, right? And you're like, I just know something. I feel something about a stock or something, right? And you take out 90% and you go invest it on the stock and you now have that cash. I imagine you now only have $100, right, invested in the insurance company. You're only getting growth on that 100. That's still, am I correct in this assumption that the 90% that you pulled out, it's not invested. I mean, it's not cash, right?
So the good thing is that when you borrow against your cash value, you're taking it from the insurance company's general funds, leveraging your cash value. So that means you keep earning interest and dividends on the entire $1,000.
Wow.
Even though you loan. This is something called non-direct recognition, meaning that you have $1,000 in cash value, you're going to get interest and dividends on 1,000, regardless of if you have a loan out or not.
That's a lot of freedom. It's like having a bank account, right? And then the bank account's growing at a certain. What's an average interest rate? Interest
Yeah.
rate right now, or return on investment?
Yeah, so pretty much the cash value in the policy grows two ways. It grows from interest and from dividends, and they kind of have a compounding effect on each other. But it typically comes out to about 5 to 6% every year.
Yeah, I don't know any bank account that will give you 5 to 6%. And it's
Mhm.
liquid,
Mhm.
so it's pretty cool. How come a lot of people don't know about it, or how come a lot of people shy away? When you talk about life insurance, is it just because a lot of insurance brokers don't know how to sell it, right? Or is it like it's a product that's misunderstood? Because even when I was younger, life insurance was thrown around to me, but it was never explained to this extent. So
Mhm.
I was just curious.
No, you're right. Absolutely. So one big reason is
Maybe
like,
I'm
for
just
example,
not there, in the head.
yeah, yeah, you're right. There's a big misconnection. A lot of, for example, people who listen to Dave Ramsey or Susie Orman talking about whole life insurance, like it's a terrible investment. Stay away from it. It could be a terrible investment if it's structured the wrong way. Like there's about 1,200 insurance companies in the U.S. that sell whole life insurance. Only four of them could apply everything we're talking about here. So that means that it's very possible for somebody to go, oh yeah, hey, I want to do whole life insurance, then go get whole life insurance, and it's not the right way. And then
Uh,
now it's like I was right. Whole life insurance is a terrible investment. It could
yeah.
be a terrible investment if it's not structured the right way from the right company and the right methods. So a lot of people that don't know these things, a lot of advisors don't even know the differences between paid up additions rider, the base premium, the difference between a mutually owned insurance company and a stock owned insurance company. In order to apply the strategy, it has to be from a mutually owned insurance company, because mutual insurance companies, they have profits and dividends, and then they give those back to the customers, to the policy owners. Whereas,
Mutually owned means the people who are putting in are the owners of it.
exactly, precisely.
Wow. So if I'm a person that's going to go get life insurance, right, and I'm working with an insurance broker or insurance company, how do I make sure that it's this insurance that you're mentioning and not the other insurance, which is not going to give you all the perks? What should person ask the company, or how could they research to know, okay, this is the one that we're talking about here. This is the one I should get.
Yeah, so there's a checklist. So number one, it has to be whole life insurance and nothing else. Whole life insurance. Number two, it has to be from a mutual insurance company. Number three, there has to be the paid up additions rider, and it has to be properly structured, typically about 50-50 split. So half of every dollar goes to the paid up additions rider, and the other half goes towards the base. You never want to do, for the most part, never want to do 100% base, or else you won't have that much cash value grow over the years. And then the fourth is the non-direct recognition feature. That's where you have, for example, the $20,000 in cash value. You borrow against it, you're going to earn interest and dividends on the entire $20,000. That's non-direct recognition. If it's direct recognition, then you won't keep earning interest and dividends on your money when you're using it. So that's kind of the checklist to look out for when, if you want to know, is this really like a good policy or not necessarily good, but could be used for self-banking purposes.
And if someone already has a policy that's not a whole life insurance policy, but they have like some value in there, can they switch it?
Or if they have a whole life insurance policy, can they buy through a mutual insurance company? Can they add on that paid up additions rider?
Yeah, so a couple of things. So if they have, for example, a whole life policy with a stock owned company, and they hear about this and they want to kind of do this now, they could, if they have cash value in that whole life policy, they can roll that cash value from one company to the next company via 1035 exchange, kind of like a 1031 exchange in real estate, and then not have to pay taxes on that. This is from one whole life policy to another whole life policy.
That's
Now let's
awesome,
say,
man.
yeah,
Yeah.
now let's say somebody has a term policy and they're paying into it. Let's say it's like a 20-year term policy. They're paying into it, and year 10 now, they're like, you know what? I'd rather have some cash value now instead of just having a term policy that's going to run out. They can convert it to a whole life policy with the same company that it's with. They can, without any underwriting.
So you're saying interest and dividends. So when the insurance company invests the funds that you have put in place, those, you're not saying like capital gains or returns.
Mhm.
Why are you using the term interest? Is that just what it's called? I mean, I imagine that the returns can vary based on how successful their fund is or how successful their investments are. And then dividends would be dividends from the companies in which they invested that then give quarterly dividends. Is that where is the interest and dividends coming from? Bottom line.
Perfect question. So pretty much when we're setting up a whole life policy, there's an illustration. An illustration shows like the figures, this is how much it's going to cost, for example, every year. And then you have a guaranteed side, and then you have a non-guaranteed side. So they're going to, on one side, they're going to guarantee you that if you paid X amount of dollars in premium, the insurance company will guarantee you X amount in cash value based on a set upon interest rate, and then also a guaranteed death benefit on one side. On the other side, it's the non-guaranteed side, which equals the guaranteed side plus dividends. So it's pretty much there's a base that they're going to guarantee, and then the non-guaranteed is pretty much saying if everything goes well, we're also going to give you the guarantees plus dividends. However, we only work with insurance companies. As mentioned, we only work with 4 companies. Of
Mutually
those 4,
owned.
I'm sorry.
Okay. Mutually owned. They're mutually owned. So
Mutually
you
owned.
own them. So of course you get dividends. Go ahead.
Exactly, yeah. And these companies have a proven track record of paying out dividends, even during the Great Depression, even during the 2000 market crash, the 2008 market crash, even during COVID, they've still been paying out dividends and interest. Obviously, the interest is guaranteed in writing, but plus the dividends. So it's kind of like a twist because we can't say guaranteed dividends, but we can bet that they're going to pay out dividends because of their proven track record and because of what the insurance companies invested in. So
How often are those dividends paid?
Annually.
Annually. Okay.
When you deposit money at a bank account, it's FDIC insured up to whatever, $250,000 per person or per bank account. Is there any whatever federal insurance on the interest payments, which are guaranteed to you in case the whole insurance company goes under?
On every state level, there's a guarantee association that guarantees the cash value, guarantees a death benefit for all insurance companies in that state.
Okay. Gotcha.
Great question. So before we started recording, we were talking, about this bank on yourself strategy. Could you touch upon that, or have we kind of touched on it already? And I want to tie it all together. I know we're short on time today.
Yeah. That's a good question. That's actually everything we're talking about is the bank on yourself strategy. So pretty much kind of to recap it, the bank on yourself strategy is using whole life insurance for self-banking purposes. So for example, you're using it to build your retirement, to become your own source of financing, to leverage your own real estate deals via your own loans, to become like your own mortgage. So that's pretty much what the bank on yourself strategy is.
When you borrow from this cash value, do you have to pay interest? And if you do pay interest, does that go back to your own cash? When you borrow from a 401k, you have to pay it back with interest, but the interest goes to you, right? Is it similar here?
Yeah. So when you borrow from the policy, you're borrowing from the general funds of the insurance company, and then you're going to pay the insurance company back interest. But while you're doing that, while you're buying their money and paying them back, you're also earning interest on your money. But typically the way it works is you're earning 5 to 6% compound interest in your cash value. And then when you're buying that money, you're buying it at 5% simple interest. So it kind of creates this arbitrage now where the cost of capital becomes cheaper for you to use your policy than other places. Because think about it this way. And a lot of real estate investors do this. Is like, let's say they have $100,000 in cash value. They borrow against that. They buy a property. They pay that property back over 5 years now. Like they become their own mortgage. They pay back over 5 years. Now they have the cash value growth, the 5 to 6% every year, plus they have the property paid up, plus they have the appreciation on the property. So they did 2 things with their money instead of just one thing. It wasn't either or, it was kind of both that they did. They grew their cash value and they had the property with the appreciation, and they wouldn't be able to do this without the loan parts of it. So the loan part of this makes it all possible.
Yes, makes sense. So basically it's kind of close, but you may actually get more return than what the interest is that you're borrowing from. And the interest does go to the insurance company. So, but ultimately it may just be a wash, or you may historically be at a net benefit to borrow from it. Okay.
It's really interesting. This is awesome. So a lot of investors are probably already utilizing this, but even I just started a life policy, and I'm still learning about it. And I hope it's all of these things. I'm going to actually listen to this again and make sure it's this. And if it's not, I'm going to be calling you.
Okay.
How can our listeners call you?
Yeah, so they can go to our website. It's finassetprotection.com, FIN, assetprotection.com. And then I recommend that people read about this concept first before jumping into it. And I'll give them a free copy of a book called Becoming Your Own Banker by Nelson Nash. I would just pretty much email them the PDF if they reach out to us. And I recommend read the book, check it out. It's a pretty good book. It talks about this whole infinite banking concept, also known as the bank on yourself strategy. And if you go to finassetprotection.com.
I have a question. When did this product come into the market?
Yeah, so this, whole life insurance has been around for over 100 years, probably 160 years. But this whole, concept, the infinite banking concept or the bank on yourself concept is about 20 years old. It's more of a modern approach to whole life insurance. Some of the differences between this form of whole life insurance and the old form is, of course, the growth of the cash value, having the cash pretty much turbocharged and grown. And of course, having the flexibility through the paid up additions rider. That's kind of the modern twist to it.
And what is the paid up additions rider like truly mean? Like that, I know there's like different riders,
Mhm.
like, oh, there's a long-term care rider that, oh yeah, I may not pass away, but if I'm
Mhm.
like disabled, I then get access to this benefit and stuff. So this is another addition to the policy. What is that paid up additions rider actually entail?
Yeah, it actually so it helps increase the cash value. It's pretty much its job is to move the cash value up and then also provide flexibility. So if we did 100% base policy, then we're on the hook for all of that base. But instead, if we did like a 50-50 split, like half of every dollar goes towards the base and the other half goes towards the paid up additions rider, we just did two things now. We created more flexibility in the policy where there's a minimum and a maximum, and then also more cash value that you can add into it. And then, of course, the cash value that's in the paid up additions rider kind of turbocharges and grows, helping you increase the cash value over time.
And what's the base value? What does that mean?
The base life insurance is pretty much a straight whole life insurance. So
Gotcha.
that's
So
pretty
you're
much
putting
the
in
life.
premiums, and there's a benefit if you pass away.
Yeah, exactly. Yeah.
Yeah, so it's the best of all three worlds, right? You're protected with the life insurance. You got access to cash,
Mhm.
and it's growing kind of like a stock with like 5 to 6% rate. Am I getting
Yeah,
this right?
exactly.
You know?
Yeah, and then you also have the liquidity too. So eventually, what you could do is like, for example, in 2008, a lot of real estate investors, one of their problems, or one of the big problems was in 2008 was banks stopped lending out money. So if you had all these properties with capital in them, the only way you can take that money back out is if you sold the properties, and of course the market values went down. So then you'd be selling it for a lower rate, or you'd have to go to a hard money lender or a private money lender. But of course, if banks stop lending, then their demand is going to increase, which means that their interest rates are going to increase. So this kind of prevents those from happening, where you have your own source of financing. Of course, you're not going to be able to start this policy off and start financing homes on your own. It's a long-term strategy. But if you do plant those seeds and you have the cash value building up, then you can essentially cut out banks, And I know you guys probably don't want to hear that as mortgage brokers, that you can cut out banks.
No,
But
ultimately, it's probably going to be more used for down payment in addition to
yeah,
that is what it will probably come down to. But
yeah, exactly.
But unless you have a large, like I see, if your insurance policy is super large, you can have, you have like $1 million+ liquid in there, then you may not need, you can
Mhm.
finance your own transaction, right? That's
Exactly.
what
Yes.
you're alluding to, right? And whereas we're thinking about like, smaller policies that really can't lend, up against a mortgage here because we're in California,
Yeah. Yeah.
yeah, but I know we're really short on time. I wanna talk to you a little bit about what we talked about before we started on. You're an entrepreneur. You've been doing this for 6 years. A message for a lot of our young listeners that are listening in, that are in college or just thinking about starting their own business, because you did say that you work. There's a couple things you said. You said you work like as if a boss is breathing down your neck,
Mhm.
right? And you you also just feel more comfortable now, as if than before when you were actually not doing your own thing or not doing this. Could you elaborate a little bit on that?
Yeah, definitely. So, one of the problems with entrepreneurship is self-discipline. People, it's, like they have a boss, right? The boss or the supervisors watch them, and it's easier for them to get stuff done. And for a lot of people, actually, most people need some sort of boss or supervisor. So when you become self-employed, that's a problem, is that kind of holding yourself accountable. But of course, through practice, you can kind of, and I have a mentor too. So the mentor also holds me accountable. That also helps too. And then as far as, but I think before all of this, even too, like if you're still thinking about becoming self-employed and doing this, is that 90% of it is mindset. So 90% of it is you believing in yourself and you planning this out in your mind, and making it happen. 10% of it is capital, connections, licensing, all that stuff, certifications, everything else. But 90% of it is you believing in yourself. And also you get what you think about. So if you're thinking about being successful and you're thinking about doing big things, then you will have that in your life. But at the opposite, if you're thinking of failure and you're thinking of you're not capable of doing it, then that will also happen too.
So
awesome.
so this is your 6th year in the business,
Mhm.
and how has the journey been from year 0 to 6?
I mean, the first couple of years it was like negative, So I had to like use, money from my savings account, credit cards, just to kind of pay bills and get through it. And now I think I'm not financially free or financially set for the rest of my life, but I definitely feel like it, at least. I definitely see it as, I don't really, because I've built this business, and I think I mentioned this to you before we recorded, is that the skills I've learned in this business I could apply to different areas. If something tomorrow happens to whole life insurance policies, I don't think that will happen, But if that does happen, I can pivot into different areas because of the skills that I've learned in this business.
And what was it that really kept you going in year 1 or 2 when you were like making no money or very slim money?
Yeah, good question. So what got me is pretty much to think of the objective, the initial objective. Why am I doing all this? And year one happened because I wanted to be financially free. I wanted to pretty much even before COVID, I built this business to be completely virtual. So I was already doing all the remote stuff before COVID. And that's what I wanted. So every time I felt like quitting, I would think of, if I go and get a job or, go do something else, I won't be able to have this business. And I kept just thinking of the long term. And it's crazy because every year that goes by, it's almost like it never happened, So it definitely takes a lot of self discipline, but once you get through it, it's definitely worth it for sure as an entrepreneur.
And our last question for the night, you might have answered it right there, but we always ask our guests here on our show, in your journey of life and business and entrepreneurship, what have you learned? What are really your, you 1, 2, 3, 4 pillars of success that you feel have got you where you are, and that drive you daily?
Number one, have a mentor or a coach, somebody that you can go to that can hold you accountable and somebody that's familiar with your industry. Number two, read a lot of books. You can literally read somebody's mind when you're reading a book, especially if it's something, if you're reading about books in your industry and people have done what you've done. Number three, plan accordingly, plan a lot, and always come back to your plans. It's not just a one-time thing where you just do a business plan and then just kind of close the book. It's every single day you're going to it, you're checking it, and have KPIs, key performance indicators, things that you can go and you could check every single day, like the amount of dials you do, the amount of emails you send, the amount of people you get in contact with. In my case, the amount of guest podcastings I do, all these metrics that can kind of build up and eventually will funnel into or will correlate with more revenue, more client satisfaction, more things will happen as a result of the indicators you're following.
Wonderful.
Well, thank you for being here today. I know time is of essence right now, and we're past the 30-minute mark.
Hit your next KPI, man.
So we got to hit our KPIs as well.
Yeah, I had a lot of fun, guys. Thank you so much for having me on.
Thanks for joining us.
Thank you so much, man. Thank you. Have a good night.
Okay.
Take care.
Thanks.
Bye.